Hello everyone, welcome to OptionGig. This is your host Vivek, part-time option trader and full-time worker, husband and father. If you also want to generate consistent monthly income trading options while working in your regular day job, then join me in this journey. Hello everyone and thank you for tuning into OptionGig. This is your host Vivek. And in this session, we're going to talk about intrinsic and extrinsic value of options. This topic is intended for intermediate to advanced option traders because this really helps us in many ways to understand what the components of option pricing is and how to use this information to make better decisions in trading. All right, so this is all we're gonna cover in today's session. We'll start to understand what are the components in option pricing. Next, we'll jump on to how the value of each component change based on the moneyness of the option contract. Then we will look at what happens to the different option pricing components at expiration. And lastly, we will also understand how to make use of this information to be a better trader, to make smarter trades, to be those 5% option traders who are profitable. All right, without any further ado, let's dive right into it. First, let's understand the option pricing and the various components of it. Now, an option pricing can be broken up into two bigger components. One is dependent directly on where the current stock price is, and the other section, which is not depending on the current stock price, but is dependent on all other factors. What is happening in the rest of the world, what is happening in the market, how much is time left for expiration, yada yada yada. So these two components are called intrinsic and extrinsic. Means an option pricing has an intrinsic value which is solely determined by the strike price and the current stock price. And then the other component of an option price is an extrinsic value. Intrinsic is derived using the current price of the underlying stock. As the word suggests, intrinsic, this is the value which is inherent or innate in that option contract. Means if you ignore everything else in the world, what is that option contract worth right now if I do not take into consideration how much is time left in the trade, if I do not take into consideration what's happening in the world, what's the value of the option contract at that point of a time, ignoring everything else but just looking at a stock? That is the intrinsic component. Now, extrinsic derived from other factors outside of a stock. Now, some of those factors are how many days are left to expiration, what's the volatility of the stock, what's the interest rate scenario in the current market. So these factors also determine the price of options, and the component of option pricing which is determined by these factors is called the extrinsic amount or extrinsic component. It is also referred as time value in option because this component is only valid until the expiration of your trade. So once there is no longer time available in the trade, this component will go away. So this is called extrinsic or time value in an option contract. Now let's take an example of it, and to look at an example, let's consider my favorite stock XYZ, and the stock is currently trading at $50. Say you want to look at a call option contract with a strike price of 45. Remember, the stock is at 50 and you're looking at a call option contract with a strike price of 45. The option premium or the price that you will pay to buy that contract will be $7. Just an example. Now let's break this $7 into the intrinsic and the extrinsic value. Now out of this $7, $5 is the intrinsic value of the option contract. Why? Because your current stock price is at 50, your strike price of the option contract is at 45. Means if you forget everything else, you have a right to call the stock or to buy the stock at 45 when the stock is actually trading at 50 in the market. Means if you exercise your call option, immediately you're gonna make $5 because you can sell the shares in the stock market at $50 after buying the stock at $45 by exercising your call option. So that is the inherent value which is embedded in that option contract, because that option contract immediately gives you $5 profit. So that is why the $5 is coming from the intrinsic value. But if there was no extrinsic value, then everyone will do it. But instead of $5, you're actually paying $7 for it, because $2 is coming from extrinsic value of that option contract. And that extrinsic value takes care of the time that is still available. Things might change in let's say next 20 days if there are 20 days remaining in an option contract. Who knows, maybe the stock price will go to 55 or the stock price could come down. So there has to be some risk and reward to be associated with what might happen during this time. Or the volatility of the stock could change. It might become more volatile. The implied volatility could change. And then someone needs to account for that. So considering all the factors, the overall extrinsic value at right now is determined to be $2. So if you have to buy a $45 call option right now, when the stock is trading at 50, you will have to pay $7 because $5 is an inherent or intrinsic value embedded in that option contract, and the $2 you have to pay for the time value. I hope this example makes it clear in terms of the breakup of the components and what is intrinsic and what is extrinsic. Let's also talk about the moneyness and how these intrinsic and extrinsic components are distributed. Let's first talk about in the money options. The example that we just looked at was an in the money call options, because if the strike price of the call options is 45 and the stock is currently trading at 50, it is in the money call option. Now for in the money call options, the option price will have both intrinsic and extrinsic value in the option premium. Like the example we saw, the option pricing was $7, out of which $5 was intrinsic, $2 was extrinsic. So in the money options will always have both the components. Now let's look at out of the money. Now OTM or out the money options do not have any intrinsic value. So the option pricing is solely because of the extrinsic value in it. Let's take the same example of XYZ, and instead of $45 call option, if we were looking at $52 call options or $55 call options, that call options would be trading say at $1. And that $1 is solely because of the extrinsic value in it. There is no intrinsic value in it because your strike price is 55. The stock is currently trading in market at 50. There is no benefit for you to exercise that. There is no inherent advantage or innate value embedded in that option contract because it is out of the money. So only if you see that option being traded at $1, it is because there is $1 of extrinsic value left in it. Let's take a real life example, this time not of XYZ, which is my favorite stock, but let's talk about DocuSign. So at the time of recording, DocuSign is trading at $88.73. So that was the last price when at which it traded. Now if I'm looking at a different strike prices, for a call side, anything below $87.50 is in the money call option because the strike price is less than the stock price, and currently the strike prices that we have available is an $2.50 increment. So the closest at the money is $87.50, which is in the money, not really at the money because the stock is at $88.73. All the strike prices below for a call option is in the money. Now conversely, on the put side, all the strike prices higher than 88.73 means from 90 strike price onwards, it is in the money. So if you look at the option premium or option price for, say, let's pick at a call option at a strike price of 80, the option pricing mid value is $10.70, and out of $10.70, $8.73 is coming from intrinsic, and almost $1.97 is coming from an extrinsic value. So it has got both the components. Now let's look at the option pricing for $95 call option. That call option is out of money, it is OTM. In that case, that option is being traded at $2.55, and intrinsic is 0 and $2.55 is completely extrinsic value. So this is a real life example that we looked at for the call. Similarly, if you're interested, you can log on to your broker platform and look for intrinsic and extrinsic on the put side also. It shows a similar behavior. In the money put options have both intrinsic and extrinsic component in the option pricing. Out of money OTM options have only extrinsic component in the option pricing. So next, moving on, let's understand what happens at expiration. You are at the last day of the trade and there is no more time left. So at expiration, because there is no more time left, there will be no extrinsic value. Remember, extrinsic value is also referred as time value because things could change in the remaining amount of time, but at expirations there is no more remaining time, so there's nothing that would change. So extrinsic value is 0 at expiration. That means for in the money options, the option pricing is solely because of the intrinsic value, because extrinsic is 0. And for OTM options, out of the money options, there is be 0 option price, because anyway out of the money options have 0 intrinsic value, and now at expiration even the extrinsic value has become 0. So out of money options will be worthless at expiration. That's the reason, because there is no more extrinsic value left in it. So at expiration, ITM is have only the intrinsic value, OTM have 0 value, they become worthless. Moving on, let's understand how we can use this particular information about extrinsic value and intrinsic value breakup to make smarter trades. One use case that comes to my mind is, how can you find out if you are at a risk of early assignment on a short call because there is a dividend coming up? And new option traders always stumped by this, because morning they log in and then they suddenly see that they have been assigned a short call, and now suddenly they see that their account has got a negative or a short stock balance. Now understanding this option pricing breakup will help you to know whether you are at a risk of early assignment or not. If you have a short call and there is an upcoming dividend, then you should look at how much is the extrinsic value left in the short call and find out how does it compare with the dividend that is expected to be paid. Now here's a secret. If the extrinsic value of the option contract is more than the dividend payout, then you are not at the risk of assignment. But if the extrinsic value left in the option contract is less than the amount of dividend being paid out, then you are at the risk of early assignment. Now why it is like this? Let's take a few minutes to understand why would someone exercise their right to call the stock at this point of a time. Because you get assigned the short call only because somebody have exercised their right to call the stock from you. Now I'm looking at the other side, the other person who has exercised their right. What's going in their mind? That person, that trader is looking at the dividend and say, let's say it's 50 cents dividend, and if he has a stock in his portfolio, he will be able to get that dividend. Remember, options don't get dividends, only stocks get dividends. So the trader who has a long call option, if he wants to capture the dividend, he will have to exercise his long call option to get the stocks in his portfolio so that he can get the dividend. But if that trader exercises his right to call the stock before expiration, what is he losing? That trader will be giving up all the extrinsic premium that is left in the trade, because he's closing the trade right now. So why would he still choose to do it and pay that extrinsic premium to close the trade? Is only if the dividend amount is greater than the extrinsic premium which is left in the trade. Because it's okay, he's losing money on the extrinsic premium side, he'll be getting more in the dividend to cover for that loss. So he'll still be okay with it. But if the dividend is less than the extrinsic premium, in that case, it just doesn't make any sense to call the stock right now and to give up more than 50 cents in the extrinsic premium to capture only 50 cents in the dividend. Just doesn't make financial sense. So that's the reason if the extrinsic value left in the option contract is more than the dividend being paid out, you are not at a risk of assignment. But if it is less, then you certainly are at a risk of assignment, and then you should look at your position and see what you want to do with that position. Next, I want to look at the use case of how to use this information to decide whether you want to stay in the trade or you just want to close the trade. For example, say you have sold an iron condor and the stock is currently trading right in the middle of your short strike prices. Assume that when you sold the iron condor, you collected $1 premium. Now at this point of a time, you should keep an eye on how much is the extrinsic value left in iron condor. If the extrinsic value remaining is 60 cents, it does make sense to stay in the trade because there is a lot of money still left on the table. You don't want to close the trade too soon and leave tons of money on the table. But if the extrinsic value left is only 10 cents or let's say 20 cents, you can choose what's your comfortable number. At that point of a time, you should really think, do you still want to stay in the trade and risk that the stock might move and then your trade can get hurt? So look at the extrinsic value to figure out how much money is still left on the table, how much of the money is still available to milk in this trade. And if the amount of money remaining to be milked is less, you might as well get out of the trade. Bank the profits that you have right now and move on, find another trade. If it only 10 cents remaining and there are 20 days left in the trade, just doesn't make any sense to take the risk on your profitable trade just because you want to milk 10 cents. Yeah. So use this information on the extrinsic value to figure out how much is the money left in the trade, and then determine whether you want to stay in the trade or you want to close the trade and move on. Next use case I want to talk about is to find out what's your overall portfolio, how much is it dependent on the stock price and its movement. To find that out, you should look at the extrinsic value not at each option contract level, but at your portfolio overall. Now, if the extrinsic value is too low, and then in some other session we can cover what does it mean by too low, but if it is low, it means your portfolio is heavily dependent on a stock price movement. Your portfolio is not at all benefiting from the fact that the time is passing by, the option is getting closer to expiration. The passage of time does not benefit you at all. As an option seller, the best thing for me is to sit back and let the time do its job. If your portfolio doesn't have enough extrinsic value, then we're not getting the benefit of letting the time do their job. Our portfolio is heavily dependent on how the stock is moving, and we don't have any control on that anyway. So keep an eye at your portfolio level extrinsic value and if you see it is too low, you might want to do the trades which will increase the extrinsic value of your portfolio. So this is how you can use this information at a portfolio level. Alright, I hope this helps you. Before we close, a quick takeaways. So today we looked at the intrinsic and extrinsic values in an option premium. Also we talked about the in-the-money options, and in-the-money options have both intrinsic as well as extrinsic component in the option pricing. Out of the money OTM options have only the extrinsic value. There is no innate value in that option contract. At expiration, the extrinsic value is 0. Extrinsic value known as a time value, and at an expiration there is no more time left. So there is no more time value left, and that is why the extrinsic value is 0. And lastly, we also looked at how you can use this information to make smarter trades and smarter decisions on your overall portfolio. We looked at 3 cases. One is how to determine if you are at a risk of assignment on your short call. We also looked at how to use this information to see if we want to stay longer in the trade or we want to close the trade and move on. And lastly, we looked at the case wherein how you can use the information about extrinsic value of your overall portfolio to determine how much is the portfolio dependent on stock movement and how much is it benefiting or not benefiting from just the passage of time. Is the time helping you or not? You can determine that by looking at the extrinsic value. Alright, thank you very much for your time. I hope this helps you. If you have any further questions, write it in the comments if you're watching it on YouTube channel, or you can email it to me at optiongig@gmail.com. Do let me know what other topics you want me to cover, and I will bring some of those relevant content for you. Alright, thank you very much. Have a wonderful day. Happy trading. Please note that all the information presented is purely for educational purposes and is not a financial or investment advice. I don't know you, you don't know me, so do yourself a favor and don't invest or trade solely based on what you hear.